people often think ETFs, mutual funds, and index funds are competing investments, but they're not. An index fund describes what you're investing in. An ETF describes how that investment is structured and is basically one way to access an index fund, while a mutual fund is another. So now that you know what an index fund is, let's walk through how ETFs and mutual funds fit into that picture and the key differences between the two. The first big difference is how they trade. ETFs trade throughout the day just like stocks. You can buy or sell them whenever the market is open, and their price moves as the stocks inside the fund move. Mutual funds, on the other hand, typically trade just once per day after the market closes at a single price. Another major difference, and this one really matters, is cost. Many mutual funds, especially actively managed ones, have managers or teams constantly buying and selling stocks in an attempt to beat the market. All of that activity increases costs. Those costs get passed on to you in two ways, through higher fees and often through higher taxes. With ETFs, the approach is usually much simpler. Most ETFs are passively managed and designed to track an index, which means less buying and selling inside the fund. And because of how ETFs are structured, they tend to be more tax efficient. To put that in perspective, many actively managed mutual funds charge expense ratios of around 0.50% or more, while broad-based index ETFs often charge closer to 0.03% to 0.10%. That fee, called the expense ratio, may sound small, but over decades it can have a massive impact on your returns. Imagine investing $100,000 for 30 years, and both investments earn the same average market return of about 8% per year. On one side, you have an actively managed mutual fund charging a 1.5% annual fee. On the other, a low-cost index ETF charging about 0.03%. Even though both investments follow the same market, those fees quietly compound against you over time. After 30 years, the mutual fund grows to about $661,000, while the low-cost ETF grows to roughly $993,000. That's a difference of over $330,000 lost entirely to higher fees.